Welcome, everyone. Today we are going to explore how volume can help us confirm trend reversals. This is an essential skill for anyone who wants to understand when a market is about to change direction. By the time we are done, you will know how to use volume to spot when a trend is weakening and when a reversal might be about to happen. Get ready because there is a lot to cover, and I am excited to share it with you. Imagine trying to predict the future of a stock or asset's movement, but with a secret weapon that reveals the true enthusiasm of market participants. That secret weapon is volume. So let us start with the basics. What exactly is volume, and why does it matter when we are talking about reversals? Volume tells us how much activity is happening. It is the number of shares or contracts being traded in a given time. Volume tells us about the energy and interest behind a price move. It can act like a confirmation tool for trends. For example, if the price is moving but the volume is not matching up, it might mean that the trend is losing its strength. That could be a sign that a reversal is coming. Now let us expand on how chart patterns interact with volume to identify trend reversals. Chart patterns are visual signals that show the collective behavior of market participants. When combined with volume analysis, they become even more powerful. One key pattern to watch is the head and shoulders. This pattern is often a signal of a reversal when combined with increasing volume on the left shoulder and head, but decreasing volume on the right shoulder. When you see the volume drop off on the right shoulder, it usually indicates a loss of momentum and a likely reversal. Similarly, the inverse head and shoulders pattern, which appears at the end of a downtrend, can confirm a bullish reversal if volume increases significantly during the breakout above the neckline. Another important pattern to understand is the cup and handle. This pattern typically forms after an uptrend and looks like a rounded bottom followed by a smaller consolidation, which resembles a handle. When the price breaks out of the handle on strong volume, it signals a continuation of the previous uptrend, making it a powerful bullish indicator. If the volume is weak during the breakout, it is best to be cautious, as the signal may not be reliable. The triple top and triple bottom are also noteworthy reversal patterns. The triple top occurs after an uptrend and signals a bearish reversal, especially if each successive peak is accompanied by declining volume. The triple bottom, on the other hand, forms after a downtrend and indicates a bullish reversal when volume picks up significantly during the formation of the third bottom. Volume confirmation is key to understanding whether these patterns will lead to a sustained reversal. Flag and pennant patterns are typically continuation patterns, but they can also signal potential reversals, especially when they fail to continue in their expected direction. A bullish flag forms after a strong upward move, consolidating in a downward sloping channel. If this flag fails to break out to the upside and instead breaks down on strong volume, it could indicate a bearish reversal, suggesting that the buyers have lost their momentum and sellers are taking control. Similarly, a bearish flag forms after a downtrend, consolidating in an upward sloping channel. If this bearish flag breaks upward with strong volume, it can signal that buying pressure is overcoming the sellers, leading to a bullish reversal. Pennants are similar to flags, but are characterized by converging trend lines, forming a small symmetrical triangle after a sharp price movement. A bullish pennant forms after an upward move and consolidates in a tight range. If it fails to break upward and instead breaks down on high volume, this may indicate a bearish reversal. Conversely, a bearish pennant that breaks upward with strong volume can indicate a bullish reversal. The key with both flags and pennants is to watch the direction of the breakout and confirm it with significant volume. If the volume during the breakout is weak, the signal may not be reliable, and the reversal might not sustain. The rectangle pattern is another valuable chart formation. It represents a consolidation phase where the price bounces between two parallel levels, forming a rectangular range. A breakout from this range, either to the upside or downside, is significant, especially if it is accompanied by strong volume. If the volume is higher during an upside breakout, it confirms that buyers are taking control, leading to a bullish continuation or reversal. Conversely, a downside breakout on strong volume indicates that sellers are dominant, signaling a potential bearish reversal. Broadening formations, which look like an expanding triangle or megaphone pattern, occur when price swings are getting progressively wider. This pattern is often seen during periods of heightened volatility. A broadening formation can signal a reversal if the price breaks through a key support or resistance level with a spike in volume. Pay attention to these formations as they indicate market indecision, and volume can help confirm the direction when a breakout occurs. Rounding tops and bottoms are other reversal patterns to consider. A rounding top often forms over a longer period and indicates a bearish reversal. Volume tends to diminish as the price rises to the peak and then increases as the price starts to fall, confirming the shift in trend. Rounding bottoms are the opposite, and they signal a bullish reversal. Volume should increase as the price moves up from the lowest point, indicating growing buying interest and the start of a new uptrend. By thoroughly understanding and combining these classic chart patterns with volume analysis, traders can significantly enhance their ability to identify potential trend reversals. The key is to not only recognize the patterns, but also to pay attention to the volume associated with them, as it is the volume that provides the true confirmation of a market shift. Another useful pattern is the double top or double bottom. A double top forms after a sustained uptrend and usually indicates a bearish reversal. Volume plays a crucial role here. If you notice that volume is high during the first peak and then lower during the second peak, it suggests a weakening trend and a reversal may be coming soon. The double top is most reliable when the volume on the decline from the second peak is greater than the volume seen on the rise to the second peak, indicating strong selling pressure. Additionally, the neckline, which is the support level formed by the previous low between the two peaks, should be broken with high volume for the pattern to fully confirm a bearish reversal. In contrast, a double bottom, which often appears at the end of a downtrend, is a sign of a bullish reversal. Volume is also key in confirming this pattern. During the formation of the first bottom, volume typically increases as selling pressure reaches its peak. When the price moves up and then returns to form the second bottom, volume should ideally decline, indicating that selling pressure is weakening. When volume spikes during the formation of the second bottom and during the breakout above the resistance formed by the peak between the two bottoms, it is a strong signal that buyers are stepping in and the trend might be reversing. This increase in volume provides the needed confirmation that the asset is ready for a bullish move. The wedge patterns, such as the rising wedge and falling wedge, are also important. A rising wedge is often a bearish pattern, especially if it forms after an uptrend. If volume starts to decline while the price is squeezing higher, it means fewer traders are supporting the price action and a bearish reversal could be near. On the other hand, a falling wedge usually signals a bullish reversal, particularly if volume increases as the price breaks out to the upside. Triangles such as ascending, descending, and symmetrical triangles are also helpful for identifying potential reversals. In the case of an ascending triangle, if the volume increases during the breakout, it indicates strong buying interest and a likely continuation or reversal of an uptrend. For descending triangles, increasing volume during a breakdown signals strong selling pressure, which usually leads to a bearish reversal. With symmetrical triangles, volume tends to contract as the pattern forms, but a spike in volume during the breakout is a key signal that the new trend direction is likely to hold. Candlestick patterns like the hammer, shooting star, engulfing patterns, doji, and morning or evening star also work well with volume analysis. For example, if a hammer forms at the bottom of a downtrend and is accompanied by a significant increase in volume, it signals that buyers are stepping in, making a reversal more likely. Similarly, the inverted hammer is another bullish reversal pattern that requires confirmation through high volume. The same goes for a shooting star at the top of an uptrend. If volume is high, it means sellers are getting aggressive and a reversal could be imminent. Engulfing patterns, whether bullish or bearish, are more reliable when the engulfing candle shows high volume, confirming strong interest in reversing the previous trend. A bullish engulfing pattern occurs at the end of a downtrend when a larger bullish candle completely covers the previous bearish candle. When this pattern is confirmed with strong volume, it indicates a high probability of a bullish reversal. Conversely, a bearish engulfing pattern forms at the end of an uptrend, and when volume is high, it signals that sellers are overpowering buyers, increasing the likelihood of a trend reversal. The doji is another key pattern. A doji forms when the opening and closing prices are almost the same, creating a small or non-existent body. It represents market indecision. When a doji appears after a strong trend, it can indicate a potential reversal, particularly if it occurs on high volume. The higher the volume, the more reliable the doji becomes as a signal that the trend may be about to reverse. The morning star and evening star are also powerful reversal patterns. A morning star appears after a downtrend and is formed by three candles: a bearish candle, a small-bodied candle, which could be a doji, and a bullish candle. If the bullish candle shows strong volume, it confirms that buyers are stepping in, signaling a potential reversal. The evening star is the opposite and occurs after an uptrend. It consists of a bullish candle, a small-bodied candle, and then a bearish candle. High volume on the bearish candle is a sign that sellers are taking over, increasing the likelihood of a trend reversal. By understanding these candlestick patterns and using volume analysis to confirm their signals, traders can more effectively identify market reversals. The combination of price action and volume is a powerful approach that provides deeper insights into market dynamics. By combining these classic chart patterns with volume analysis, traders can better understand market sentiment and increase the likelihood of identifying true reversals instead of false signals. Now, how do we spot these reversals with volume? Here is something to watch for: a divergence between price and volume. Imagine the price keeps rising, but the volume is falling. What does that mean? It means there are fewer traders behind the move, and this usually means that the trend is running out of steam. Another important sign is a spike in volume when the price reaches support or resistance levels. When you see volume pick up near one of these key levels, it is a big hint that a change may be coming. Let us break this down further by looking at how to use volume to confirm a bullish reversal. Say that prices have been falling, but suddenly you see that the volume is increasing. That tells us there is more activity going on. If the volume keeps rising and the price starts to flatten or even turn up, that could mean a reversal is on its way. Watch for volume spikes at support levels too. When the price hits support and volume jumps, it means buyers are getting involved. If the price starts to stabilize or form a bottom while the volume is high, the reversal is more likely to stick. But what about bearish reversals? If prices are climbing higher but the volume starts to fade, this means fewer traders are supporting the upward trend. This is a clue that a bearish reversal could be near. You should also keep an eye on volume spikes at resistance levels. When the volume increases as the price reaches a resistance point, it often means sellers are stepping in. This can lead to a reversal. Look out for exhaustion patterns like a double top combined with a volume spike. That is often a strong sign that the trend is running out of momentum. Now let us talk about using volume indicators to help confirm these reversals. There are several powerful tools that you can use to analyze volume in relation to price movement. One of these is called on-balance volume. This indicator adds volume on days when the price goes up and subtracts it on days when the price goes down. It gives us a picture of whether money is coming into or leaving an asset. If the price is moving higher but the on-balance volume is staying flat or falling, that tells us a bearish reversal might be around the corner. On the other hand, if on-balance volume is rising while the price remains stagnant, it may indicate a potential bullish reversal. Another useful tool is the volume oscillator. The volume oscillator compares short-term and long-term volume trends by subtracting a longer-term volume moving average from a shorter-term volume moving average. The result is displayed as a percentage or a value, which helps traders assess whether recent trading activity is increasing or decreasing relative to historical averages. If the oscillator is dropping while the price is rising, it could mean that the upward move is losing power, hinting at a potential reversal. Conversely, if the oscillator is rising while the price is stable or starting to increase, it can suggest a possible trend continuation or reversal. The accumulation distribution line is another great indicator for assessing whether a stock is being accumulated or sold off. It is calculated by combining price and volume data to determine whether the asset is under buying or selling pressure. When this line diverges from the price, it can be an early warning of an upcoming reversal. For example, if the price is making higher highs but the accumulation distribution line is flat or declining, it suggests that buying interest is fading and a bearish reversal might be near. Conversely, if the price is making lower lows but the accumulation distribution line is rising, it indicates that accumulation is occurring and a bullish reversal could be on the horizon. The Chaikin Money Flow CMF indicator is another volume-based tool that helps traders understand the buying and selling pressure within a market. The CMF looks at both price movement and volume over a set period to determine the strength of a trend. If the CMF is above zero, it indicates that buying pressure is prevailing, while values below zero indicate selling pressure. When the CMF diverges from the price, such as when the price is climbing, but the CMF is moving downward, it could signal a potential reversal. The Money Flow Index MFI is a momentum indicator that uses both price and volume data to measure buying and selling pressure. It operates similarly to the Relative Strength Index RSI, but incorporates volume into the calculation. The MFI moves between 0 and 100, and values above 80 indicate an overbought condition, while values below 20 indicate an oversold condition. When the MFI diverges from the price, such as when the price is rising but the MFI is falling, it may signal a trend reversal. Finally, the Klinger volume oscillator is designed to capture long-term money flow trends while remaining sensitive enough to detect short-term fluctuations. It uses price and volume to create an oscillator that moves above and below a zero line. When the Klinger volume oscillator crosses above the zero line on strong volume, it indicates potential bullish activity, while crossing below it may indicate a bearish reversal. Divergences between this oscillator and price action can provide early warnings of trend reversals. By combining these volume indicators with classic chart patterns, traders can gain a more complete understanding of market sentiment and improve their ability to identify and act on potential reversals with confidence. Let us move on to some practical trading strategies that use volume to spot reversals. The first strategy is what we call a volume-confirmed breakout. This occurs when the price breaks a key support or resistance level on high volume. High volume at this level confirms that there is a strong interest from market participants, signaling that the market is ready to make a significant move. When using this strategy, it is crucial to see a clear surge in volume at the moment of the breakout, as this is what separates a true breakout from a false one. A breakout on low volume may suggest a lack of conviction and increase the risk of a failed move, often referred to as a false breakout or bull/bear trap. Another strategy is called trend exhaustion with volume. This strategy involves monitoring the volume for spikes that coincide with well-known reversal patterns such as head and shoulders, double tops, double bottoms, or wedges. For example, if a head and shoulders pattern forms and the right shoulder is accompanied by decreasing volume, it can signal that buying interest is drying up. When volume then spikes during the breakdown below the neckline, it confirms the bearish reversal. Similarly, a double top or double bottom with diminishing volume as the second peak or trough forms, followed by a volume surge on the breakout, can provide a strong signal for trend exhaustion and a reversal. Waiting for volume confirmation in these cases is crucial to avoid false entries based solely on price action. Finally, there is the volume-based divergence strategy. This strategy focuses on identifying divergences between price and volume. For example, if the price is making higher highs while volume is decreasing, it indicates that fewer traders are participating in the rally, which often leads to a weakening trend and an eventual bearish reversal. Conversely, if the price is making lower lows but volume is increasing, it suggests that sellers are becoming exhausted and buyers may soon take control, signaling a potential bullish reversal. When using this strategy, always wait for price action to confirm the divergence before entering the trade. For example, if volume diverges and you expect a reversal, look for a candlestick pattern or key level break to validate the signal before entering the position. Using divergence alongside volume helps add an additional layer of reliability to reversal signals, reducing the chances of acting prematurely. We cannot forget about managing risk when trading reversals. For placing stop losses, put your stops just beyond key volume levels, like the last high or low point. That way, if the reversal does not hold and volume picks up again, you will limit your losses. As for position sizing, start small when you are still waiting for a reversal to confirm. Once volume gives you that confirmation, then you can increase your position size. When it comes to taking profit, aim for previous support or resistance levels. If the price reverses on strong volume, there is a good chance it will make it to the next key level. I also want to talk about some common mistakes to watch out for. One big mistake is ignoring volume divergence. If the price is moving but volume is not backing it up, then the trend is likely to be weak. Another mistake is overreacting to volume spikes. Not every spike means a reversal is coming. Make sure to wait for other signals from the price before making a move. Finally, do not forget to consider the overall market situation. A reversal is much more reliable if it lines up with the broader market trend or with economic data and news. We can also combine volume with other indicators to improve our accuracy. Moving averages are a good choice. When you see volume spikes near a moving average crossover, it can be a strong sign of a reversal. The relative strength index is another powerful tool. It tells us whether an asset is overbought or oversold. If the relative strength index shows a reversal and volume backs it up, that is an even stronger signal. Candlestick patterns are also useful. Look for patterns like a doji or an engulfing candle, and then confirm it with a high volume reading. This combination will help increase your chances of success. Let us do a quick recap. Using volume to confirm trend reversals can be very effective. Watch for divergences between price and volume, and look for volume spikes at key levels. Use indicators like on-balance volume or the volume oscillator to help confirm what you are seeing. Do not forget to combine volume with other tools like moving averages and the relative strength index to make your analysis stronger. Volume is one of the most reliable indicators for spotting when a trend is about to change. With practice, you can use it to anticipate market shifts. This will give you an advantage in your trading. The more you practice, the better you will get at recognizing these signals. Soon you will be making more confident and profitable trades. Remember, keep an eye on the volume, stay patient, and trust the signals when they are there. If you have questions or thoughts, always feel free to share them.